Want to know the secret to minimizing risk while maximizing your investment potential? Today, we're diving into how to build a diversified portfolio. This could be the difference between smooth sailing and turbulent waters in your investment journey. Imagine this. You're planning a big trip. Would you pack just sandals for a beach vacation? Or would you throw in some hiking boots and a raincoat too? The same principle applies to investing. A diversified portfolio is your all-weather gear, protecting you from unexpected storms in the market. So, what exactly is diversification? Simply put, it means spreading your investments across different asset classes, like stocks, bonds, ETFs, and real estate to reduce risk. By doing this, you avoid putting all your eggs in one basket. If one investment takes a hit, others can help cushion the blow. Let's break it down into actionable steps to create your diversified portfolio. First, know your risk tolerance. Are you an adventurous investor ready to embrace volatility? Or do you prefer to play it safe? This self-assessment will guide your asset allocation. For example, if you're younger and can weather market ups and downs, you might allocate a higher percentage to stocks. But if you're nearing retirement, you might lean more toward bonds to preserve your capital. Next, consider your time horizon. How long can you keep your money invested? If you're saving for retirement that's decades away, you can afford to take more risks. If your goal is just a few years out, you'll want to prioritize stability. Now let's talk about asset classes. Stocks can be a thrilling ride. They have the potential for high returns but come with higher volatility. Imagine buying into a tech stock 5 years ago. You could have seen your investment skyrocket or plummet. That's the stock market for you. On the other hand, bonds are like a safety net. They provide fixed income and are generally less risky than stocks. Think of bonds as the reliable family sedan. They get you where you need to go without much fuss. They're particularly attractive when you want steady income and capital preservation. Next up, ETFs, or exchange-traded funds, are like a buffet of investments. They allow you to buy a mix of stocks and bonds in one package, making it easier to diversify without having to pick individual securities. Picture an ETF as a well-curated playlist. You get a bit of everything, and it's all in one spot. Don't forget real estate. Investing in real estate, or REITs, real estate investment trusts, can add another layer of diversification. Think of it as owning a piece of property without the headaches of being a landlord. It can provide both income and appreciation, adding stability to your portfolio. Now, a practical way to think about allocation could be 70% stocks, 20% bonds, and 10% alternatives like REITs or commodities. But remember, this is just a guideline. Your ideal mix should reflect your personal goals and comfort level. As you build your portfolio, keep an eye on rebalancing. This means adjusting your investments periodically to maintain your desired asset allocation. If one asset class outperforms, it can throw your balance off. Think of it as tidying up your room, keeping everything in its right place. Before we wrap up, here are some key takeaways. First, assess your risk tolerance and time horizon. Second, diversify across asset classes: stocks, bonds, ETFs, and real estate. Third, don't forget to rebalance your portfolio regularly. Are you ready to take control of your investments? Are you team stocks or team bonds? Drop a comment below and let us know what's in your portfolio. And don't miss our next video, where we'll explore a hidden gem in investing that could change the game for you. Stay tuned.